Welcome everyone to this afternoon session. This session is about priorities for the euro area. And as we know, there have been a lot of reforms in recent years. Let me mention just a few of them. I mean, the banking union, I think, was the most important or most significant institutional change in the European Union since the creation of the euro. We know it's not complete yet, but at least it's up and running and functioning. There have been a lot of efforts have been made to coordinate more economic and other policies, including the creation of this half-yearly or annual session of the European semester, which runs for half a year in each year, which aims to coordinate and advise countries on various kinds of policies. And there were a lot of crisis management facilities created, including the permanent European stability mechanism. The ECB has stepped up its roles and indeed did whatever it could take to save the euro. So a lot of efforts have been made and a lot of institutional changes have been made in the past decade of the euro. Yet, I think we can still say that the euro area is still incomplete, and there are very different views about how serious the situation at the moment, whether with its current institutional architecture, the euro will not just survive, but also will prosper, or on the contrary, the euro still suffers from such major institutional fragilities that the next downturn or crisis might be as severe as the previous one, which might also risk the existence of the euro. And these are the topics we would like to discuss today, and I am really honored and pleasured. It's a great honor and pleasure to have four really distinguished colleagues with me. Let me introduce them alphabetically. Laurence Boone, who is the chief economist of the OECD since last year, I believe. But before that, she was the chief economist of many other institutions. And in fact, you also worked at the OECD earlier, I think. Then we have Vítor, Constâncio, who returned to the academia in Lisbon. But before, he was the vice president of the ECB and the governor of the Central Bank of Portugal. We have Ashoka Mody, who is currently a visiting professor at Princeton University and also has an affiliation with Bruegel, and he had a very long career at the International Monetary Fund, and he has just recently published a book on the euro tragedy, which I think was a very successful and very critical book at the same time. Maybe the success was due to its critical nature. We will learn, hopefully, this afternoon. And last but not least, we have Thomas Wieser, and we are very pleased that he is now a fellow at Bruegel. But before that, he had many positions, including the president of the Euro Working Group of the Economic and Financial Committee for long, and many other positions in Austria. So I think we have, and also let me introduce myself. I'm Zsolt Darvas, a senior fellow at Bruegel. So I think we have a great team here to discuss the issue of the current state of the euro area and its future prospects. And what I asked the panelists not to prepare long initial speeches, but instead we will try to discuss the issues through a couple of shorter questions and shorter answers. And I hope to have a very interactive and dynamic discussion. And also I would like to open the floor for giving sufficient time for all of you to make comments and ask questions. So we start with Laurence, and the very first question is very simple, is that what do you think, how complete is the current state of the euro area? Again, I would like to separate the analysis of the current situation maybe in the first part of our discussion, and the second part of our discussion then, what are the current proposals, how good they are, what else should be done, and what are the prospects for the future. But let's start for the assessment of the status quo. So Laurence, the floor is yours.
Thanks, Zsolt, and it's a pleasure to be here. There is one European institution that kept on expanding, consolidating, and growing, and it's Bruegel, and its annual event just after the summer when we're all still very happy and enthusiastic. So thanks for the invitation. So obviously this is a tremendously difficult question, but and I think we should start from the fact that there has been immense progress when we look today versus 2011 when I was on financial market, and I can tell you there were questions about the survival of the euro itself. So the lot has been done, and we can look at things from the 4 policy elements of EMU architecture: monetary, fiscal, financial, and structural. And let me start, I will review each of them very rapidly, and then highlight one common thread and explain where I think we are. And it will be short, don't worry. On structural, I think it's fair to say that progress have been mixed. If we look at the decade since the crisis, southern countries have done a lot in terms of improved wage competitiveness, and that's reflected in the collapse of their current account deficit. The same is not symmetric in the north, so let's say it's mixed. On the monetary side, I share what you were saying earlier. It's been amazing, right? If you look back 10 years ago, first, there has been plenty of liquidity, and the role of lender of last resort was well fulfilled. Second, the euro is still here with as many country members as before. There's been no deflation, which we all feared. The output gap's pretty close, and inflation's moderate, perhaps you could say a little too moderate. Then on the fiscal side, rules, we could say that they've been sensible in the sense that they have, let's say the situation would have been worse if they had not existed. We had one crisis at least, but we had overall something that held up. But we could also say that they've not been effective because during the crisis, we didn't have the appropriate fiscal stance for the Eurozone. And perhaps today a question mark is whether we're in the right fiscal framework. And then there is financial policy. Obviously, it didn't exist when we got into the crisis at the European level, or barely. And there, you could say that the launch of the banking union and the launch of capital market union have been big steps ahead, but you could also say that they have stalled. And it's quite a while since 2012, I think, where progress have not been made. Now, once we've gone through these 4 elements, what's the common thread? I think it's institution. And institution is the main, one of the main, if not the main variable explaining the differences to this policy element. If you start from monetary this time, then we have one institution which speaks for the whole of the Eurozone. And it can respond timely and massively. And it did so. Not everything was perfect, but it's been there and it's been timely. If you look at fiscal, I think Thomas done a tremendous job, and we should all be very admirative, and it's a very humble economist who says that there has been some coordination, but there's also been some struggle. We cannot deny that there has been a crisis and that we have an issue today. We have an issue that if the rules are being reformed, they're not appropriate when we are entering a world where we're probably closer to secular stagnation than violent cyclical movement. And if we enter worlds when growth is slowing down because of secular changes in trade policy or energy or digitalization, then we need a fiscal framework that will support investment investment today to prevent growth from continuing to slide and investment for the economy of tomorrow. We need to leapfrog from the 21st century to the next digital energy clean century. And we haven't got the institution for that. The other thing when we look at institution is financial. It's more fragmented than for fiscal. In fact, there is an allocation of responsibilities which leaves a lot to national supervision and a lot to national implementation of common rules and regulation, and that's not helping the banking union or the capital market union to progress. And I think it has a lot to do with the way that the setup is being done with very much, with a lot of decentralization. And then structural, then here institution is even a lot looser in the sense that we are simply talking about very soft coordination. And most of it is at the national level. And you can see that there, the results for them to be symmetric and act for the benefit of the whole Eurozone, there's no really proper institutional framework. So to conclude, that's what I would say. It's been an amazing journey given what we've, the seas and the waters on which the Euro has navigated, but there's quite a lot of progress, more to be done on the institutional side.
Thank you very much. Let me have a very quick, in less than 1 minute follow-up question, because you were using the word amazing for monetary policy of the ECB, but I think you gave a presentation in Sintra recently when you were critical and saying that the real monetary stimulus came too late. So how do you see the liquidity provision, financial stability type of actions of the ECB, but I would more interested in the monetary macroeconomic stimulus issue?
Okay, so that's a good question, and since I can dive a little more into this, I will answer. First, I didn't say it was amazing to make Vítor blush, let's be clear. I did say it because I think at the end of the day, monetary policy did an amazing job, where institutions also contributed to actually delay the appropriate response, I think, is in the way that the central bank had to look for consensus and also to make sure, so it's within the ECB, and you know that there were discussions and dissensions with the involvement of some court of justice, so it's difficult, I guess, to reach a consensus when you start from this situation. And also, if you look at the US, there was, as we know, in the US, one fiscal treasury. In Europe, you have 19 euro treasuries, and the discussion that's necessary during a crisis is longer. So I think it's, again, partly institutional, partly because of learning to build up a consensus within the ECB that there was some delay in moving into QE. And then it's also fair to say that there were some policy mistakes in 2011 when we hiked rates, which had to do with the assessment of the economic situation. But it's always easier to say with the benefit of insight.
Thanks very much. Now, Vítor, let me turn to you. So, how do you see the completeness of the euro area? And you could also comment the ECB monetary policy if you wish.
Well, thank you, and thank you for inviting me to be here in this excellent panel. As you said, and Laurence said too, there were many reforms since the beginning of monetary union, which completed missing parts of appropriate concept of what a monetary union is. But we have to recognize that the initial concept, the initial design was too narrow, and many things were missing from the start. Well, it was partly due to the macroeconomic thinking of the time that this narrow concept came up, but also it coincided very much with the views of ordoliberalism in Central Europe. There was, for a moment, more than a decade, a sort of coincidence of economic thought in that respect, with the idea that monetary policy in itself and exclusively dedicated to a price stability target would be enough to ensure at the same time both macroeconomic stability and financial stability. That would be enough. That was the thinking. Also combined, of course, with the idea, which was common in macroeconomics at the time, that the financial sector per se was self-equilibrating and would not generate real economic fluctuations because it was not in the basic macro views and macro models of the time. So the crisis exposed, of course, all these narrow concepts. And now, looking back with insight and thinking about what a monetary union implies, and the main thing that implies and was missed from the start, it is that it triggers a huge financial integration, the monetary union per se, which increases interdependencies, spillovers, contagion among the member countries that require policies to address that. So if we look back, I can list 5 missing things at the beginning, which, as I said, several have been covered. Well, the first one was the absence of crisis management and any sort of foreseen financial assistance to member countries. That was not in the initial concept. It came later with the ESM and with the crisis, and that part we can consider it has been done. The second missing thing was that it was not foreseen that interventions in the bond market to stabilize it and to address 2 types of things, either liquidity squeezes, pure liquidity crisis issues, or impairment of transmission of the single monetary policy to all the parts of the monetary union. And this was not seen or foreseen in the initial design. And that had to be covered by the ECB stepping up and indeed adopting policies that were then challenged, as we know, in several countries and courts and all of that, with the end result that indeed these courts in the end agreed that the policies pursued by the ECB were legal and according to the treaty. So I am also assuming that this part perhaps is now accepted, that the ECB has the powers and the competences to do these responses to liquidity crisis and to impairments of transmission of monetary policy, and that interventions in financial markets are then appropriate and legal. So I assume that is solved, still challenged in some parts. The third thing that was missing, and is still missing, is no macroeconomic management of the space of monetary union was foreseen. No concept of a macroeconomic policy mix as something necessary for the space of monetary union. So there was deep integration in the monetary field, but of course not in the fiscal policy area. No concept that stabilization policies implying the appropriate policy mix for the whole area were needed. And there is still a deficiency in what regards macroeconomic management at the level of the European Monetary Union space. The fourth thing that was missing was also the requirement that came evident with the crisis, that the financial integration triggered by monetary union required micro and macro supervision of the financial system at the European level. And then came later and still is being built up. The fifth thing it's not so significant as these 4 that I listed, but it's just a missed opportunity. There was no idea that monetary union would facilitate, imply, and in the end also require capital markets union. That this link was not perceived as an important link. And so we are indeed in Europe suffering from a big waste that we did the monetary union, which is a very difficult thing to do, to share monetary sovereignty, and we are not reaping the advantage of having more integrated capital markets. So, and that is also, so this is my general answer, details to come.
Yes, I will be especially interested to hear your views on the third point, not now, but maybe in the next round, when you mentioned that still we mix a more macro policy mix whereby not just monetary but fiscal and other policies are managed together. But let me now turn to Thomas and ask a similar question, but you could also comment on this, how this very special institutional nature in the Eurozone, whereby we have basically currently 19 separate countries with independent national parliaments and independent constitutional systems, but on the other hand, they are sharing the same currency, and how can they work together, how can they coordinate together, how well this is currently organized?
Thanks very much. I think it's very easy to design a monetary union that works perfectly, especially if you start from scratch, i.e. having no country and then you build up every country by itself. Or you take the United States, where thanks to 200 years of integration and all of the bumps they had on the road and crises they had on the road, evolved with one central budget and the FDIC and the Fed, etc., etc. So I'd like to talk a little bit about the realities that we have in the euro area, and especially from the point of view of institutions versus rules. And I think Mario Draghi fairly often made this distinction, rules versus institutions. And if you do not have the central institution, we're talking about monetary policy, then you need rules. So if we look at the 4 policy areas that Laurence was mentioning, in the field of monetary policy, everything clear, institution, duck. Sovereignty was transferred from all member states will be miffed if I said from the periphery, but well, that's the periphery. From the periphery to the center, and that's it. Financial, comme ci, comme ça. There was a certain element of sovereignty sharing, which resulted in the creation of the single supervisory mechanism. There was a certain element of sovereignty sharing in the setting up of the Single Resolution Board and the Single Resolution Fund, but it is an incomplete sharing of sovereignty. And it is mixed and with a large degree of national discretion, either voluntary or involuntary, seen from Frankfurt or from Brussels. So the big question is, if you have not had a complete centralized institution with a constitutional transfer of power to the center, are the 19 member states willing to have their national financial institutions, supervised, maybe yes, maybe no, resolved by outsiders, by non-nationals? And so far, I'd say our experience has been not so superb. There has been the true resolution of one Spanish bank, about which I could talk not as long as Vítor, but at a certain length. And the attempts to resolve other banks, especially in Italy, ended in them being wound down or according to national legislation in a manner which, contrary to the intentions of bank resolution, recovery and resolution, were done more at the expense of the taxpayer. So there is an element, and there are lots of studies by the Commission and others that everything was in agreement and in accordance with European rules, but à discuter. So this is an area where we still are forced to follow European rules. And the question is, what happens if member states or other actors do not follow the rules? However, this is even more forcefully the case in the fiscal area. And Vítor was talking about the absence of a decent macroeconomic policy mix. Laurence was talking about the wrong fiscal stance. Now, quite obviously, we do not have a fiscal institution. We have 19 fiscal institutions, otherwise, if you look at the constitutions, otherwise known as 19 national parliaments. There is absolute national sovereignty and autonomy on 19 national fiscal policies, and that's what we see in everyday life. Absent an institution, we've got rules. These rules are known, unfortunately, as the Stability and Growth Pact, and the manual, I think, has been shortened down from 130 to 105 pages or something like that. There's one person who really understands it, he's not in the room. The other hundreds of thousand people understand parts of it. But why do we have the rules? Because we don't have an institution. How do we produce, what do we do if somebody goes against the rules? They say, oh, we open the treaty, and under the 12th step of the procedure, we find them like hell. No. For the last 24 years, I've been reading that, and to all of our knowledge, this has never happened. So how, and I think we all recognize how important it is to have an intelligent fiscal policy that interacts intelligently with monetary policy, an intelligent fiscal policy that is growth promoting, etc., etc. How do we force countries to do that? We can't. A fortiori, how do we force countries to contribute to a decent fiscal stance, whatever that may be? And in the past, we've usually said the euro area has the correct fiscal stance. Unfortunately, its composition is totally wrong. The ones with the low debt are not spending enough, and the ones with the high debt are spending too much. So we need to think of the future in the medium term of the euro area in these terms. There will not be a shift of constitutional power of major proportions to a central institution. If that is not the case, rules remain the rule of the game. How do we deal with a Europe with 19 separate constitutional sovereignties, with the need for respect of rules, especially if they should be flexible in order to be intelligent? What does that say for the role of a political or non-political commission? And how can we ensure an optimal outcome on that? So I leave that for dinner, but these are indeed, if we look at what is going to concern us over the next 5 or 10 years, this is the question. So I will not bewail the lack of this, that, or the other. I think this is the central political question.
Thank you very much, Thomas. But I hope we can discuss issues not just at the dinner, but also maybe in a second and third round. No, but it was a perfect introduction and perfectly provocative, I think, and thought-provoking introduction. So we will come back to that issue, but let me now come to Ashoka. So, yeah, I think it's on. So given all the realities that also Thomas mentioned, that we have 19 sovereign states sharing some sovereignty in certain areas, much less in others, especially very little in fiscal, and given also the tremendous efforts that have been made to complete whatever is possible to complete in the euro area, how do you see the current status of the euro area? Is it?
Yeah, so thank you very much, Zsolt, for having me. I don't know, I saw Guntram. I also want to thank Guntram for giving me a home here at Bruegel for many years. So in January of 2017, Emmanuel Macron was speaking at Humboldt University in Germany. And he said, the euro area is in a half-pregnant state. Now you can think about what half-pregnancy means. Relationship without commitment, friends without benefits. You can have many metaphors over there. But essentially it goes back to what Thomas Wieser was saying. That the incompleteness of the European single currency, so Europe doesn't have a monetary union, it has a single currency. The incompleteness arises from the fundamental fact that it is a single currency of a confederation of states. Europe today is exactly like the United States was between 1776, War of Independence, and 1791, the Constitution. The Constitution in America in 1791 created a federal government with the authority to tax and the coercive authority to collect those taxes. It then took another 170 years before a monetary union was created and another 90 years before a fiscal union was created. This is for a good reason. This is for a good reason. The nature of policy making always requires discretion. There is never policy making by rules. Every policy, even the gold standard, allowed for contingency and exceptions. And contingency and exceptions require trust, require a certain amount of judgment. And the question then is, if you have flexibility and contingency and judgment, who is to exercise it? That is the central question. And the centrality of that question becomes important because in a federation, there is a natural authority who exercises that discretion because that authority has political legitimacy. And if you do not have a politically legitimate authority to exercise discretion, a single currency will always fundamentally remain incomplete. It will always be the case, therefore, that there will never be a fiscal union, there will never be a banking union that's worth the name, because common deposit insurance will not happen, because a capital market union also requires a harmonization of policies of such an extraordinary kind, which harmonizes countries which have completely different traditions. A capital market union requires the elimination of political risk. And in a more sort of basic way, the European Central Bank is not a normal central bank. It is the central bank of a confederation of states, or what Europeans call a Europe of nation states. As a result, all decision-making, right from the beginning, is prone to denial, delays, and half measures. You can trace the pattern from the very beginning to even the most recent patterns. That is natural. The one thing that Helmut Kohl understood about monetary union, which he pressed, was that if you have a divergent group of countries with a single currency, they will have different interests. There's nothing mysterious about it. And if they have different interests, so today, for example, just come back to today. Today, the real interest rate for Germany is negative 1.5%. The real interest rate for Italy is in the range of 1 to 2%. Carl Otto Pohl said in 1988 that a single currency will make the strong stronger, the weak weaker. Nicky Calder said this, Alan Walter said this, and that process will inevitably continue. That can never, within the current framework, however much technological virtuosity we use, that will never change because it is inherent in a single currency that it will amplify the economic divergence, and therefore it will deepen the political divisions.
Thanks, Ashoka, very much for this, I think, somewhat provocative remarks, but you mentioned that the single currency, and let's use the term single currency, I mean, we will see what others will say on that, will always drive divergence. I think there could be an agreement that until we don't have indeed a federal state with political legitimacy, the euro area will always remain incomplete. But my short follow-up question to you, and again I will ask to the other three panelists too, is that how serious is the situation? So can we live with this incomplete euro or single currency or monetary union? Or do you foresee that without measures that we can discuss later, or new further integration efforts, the euro is doomed, or at least will lead to a persistently lower growth rate and continued divergence and a lot of social and political problems. So what's your thinking on that?
Look, the basic source of low growth, as Laurence also said, is within the nation state. I'm not claiming that the euro is the source of low growth. There are fundamental problems of education, technological change, which are at the level of the nation state. But what the euro does is it makes the weak weaker and the strong stronger. That is an analytical proposition that is so self-evident and repeatedly verified by the evidence. Therefore, to answer your question, will the Eurozone muddle through in this framework? And the answer, Zsolt, has to be that in some sense, the metaphor over here is that of a glacier. The glacier, the scientists use the word calving, where small bits fall off the glacier. And the glacier does not necessarily crack, but there are non-linearities. There is a certain point at which a large chunk can carve off, and at that moment you have a crisis. So will there be a crisis in the next 6 months? I don't know. And will there be a crisis in the next 3 years? I don't know. But what I can say is that the weak will continue to become weaker. And therefore, the risk that weakness at some point metamorphoses into an existential crisis will always be present.
Now, Vítor, let me come to you, because you come from Portugal, which is probably among the weak countries. So how do you share this assessment that the euro makes the weak countries weaker and there is little hope against that?
Well, I don't share that. I also don't share the idea that without the federation there is no viable monetary union. And you see, Thomas, extrapolating from your approach with the difference between institutions and rules, you are saying either there is institutions, meaning full integration and common policies, including in fiscal, or then there are very difficult rules. But we need institutions, which is in the end converging with the idea that we would need a full-fledged federation. And I don't agree with that view. I think that there are needed reforms that I hope we have time to discuss a little bit that can indeed mend, repair, improve the management of a monetary union in the present institutional framework. The idea, yes, the idea of weak and weaker countries, I also do not share. That would lead us to a big, more technical debate, which we could not have here, because your idea is predicated on the view of the crucial role of the exchange rate in the management of our economies. And you assume, and you develop that in your book, indeed, and we also had a small exchange of emails about it at one point in time. You have the view that for countries with so many differences, some strong, other weaker, the elimination of the exchange rate creates a huge, unsurmountable problem. I don't share that view, because if we follow the way the world trade changed and the role of supply chains and other factors, we see in many academic papers that the role of the exchange rate has diminished in importance for the management of our economies. There is a list of reasons. So the path-through of changes in the exchange rate is much smaller than it was 20 or 25 years ago. That in many studies that are more encompassing of the variables that can explain behavior of the performance of the economy and performance of exports and imports, there are many other factors that now dominate the contribution of relative prices and real exchange rates. And that's why, for instance, if we take the increase in exports since 1999 at constant prices, the best performer was indeed Germany, but the second one, to perhaps your surprise, was Portugal in terms of dynamism, increase of exports cumulatively from 1999 until 2018. And then comes Austria, Spain, and below comes France, and then much below comes Greece and Italy. You have the same sort of view if you take the evolution of GDP per capita since the beginning of monetary union in real terms, or better still, in purchasing power parity terms. You see that the two countries that performed worse than all the others, the big difference, are Italy and Greece, which have their own problems. So it was not the euro, it was not the exchange rate, and so I don't subscribe to your view in that respect, that necessarily having the euro makes the weak countries weaker as an absolute necessary result. The experience of my own country does not prove that. Spain the same, Ireland the same, and so on. So that is nevertheless an introduction to what I hope we have time to discuss, which is how to improve some rules and some ways that monetary union works in the field of fiscal stance and in the field of financial stability, meaning micro and macro supervision policies, in order to improve the way the monetary union can be more resilient and work more efficiently.
I would love to also have your views, but let me give the chance to Ashoka to respond, because I see a very strong disagreement between you two.
I can be very quick on this. Look, on the exchange rate, Vítor, I don't know what studies you're looking at. There are two IMF studies, 2015, and one recently, which was co-authored by Geeta Gopinath, who is the chief economist of the IMF, a well-known expert on international economics. The story is very clear. Exchange rates matter. Exchange rate matter hugely. The European experience on that is also clear. In the crisis in 2007, 2008, three countries devalued enormously: Poland, Sweden, and the United Kingdom. The UK blew it up with unnecessary austerity, but Poland, the sharp depreciation of the zloty was crucial to the stabilization of Poland. Remember, exchange rate is not a mechanism for long-term growth. An exchange rate depreciation is a bad thing because you make yourself poorer. You acknowledge that I will buy less of your products for what I supply to you. But an exchange rate depreciation is an extraordinarily important shock absorber. It's like saying, I'm going to drive a car without a shock absorber. Most of the time you'll be fine. But some of the time you'll be in such deep trouble that you want a shock absorber. And that is exactly the purpose of the exchange rate. As far as weaker and stronger, we see that in the real interest rates, Vítor. Germany is going through a very difficult period, but let's stipulate for now that Germany, even with its current weakness, is still the strongest economy in the Eurozone. Germany has a real interest rate of negative 1.5%. That negative 1.5% real interest rate in Germany gives it an enormous boost. Italy, which is the weakest, has a real interest rate of between +1% and 2%. Italy needs a real interest rate of negative 3% for it to come out of its growth, or an extraordinary depreciation, neither of which it can have. So it is in a macroeconomic trap. So I think the evidence on this is very simply very clear. Just on Portugal. On Portugal, you cited a data on exports, which I'm not familiar with. But I do know, and Olivier Blanchard has written extensively about this, that up until the crisis between 1999 and 2009, Portuguese per capita income did not grow. So I don't know what exports grew, but Portuguese per capita income did not grow for almost 20 years. So, yeah. Well, you'll have to debate this with Olivier.
No, that's what I said.
Okay, now, Laurence and Thomas, would you jump into this discussion whether the euro makes the weak even weaker?
Yeah.
Countries, and companies, and institutions.
Okay.
Laurence?
Okay. There's so many things to answer. I don't know where to start, but I will start anyway. First, perhaps, let me jump on the exchange rate. First thing, let's just remind you that the unique currency was precisely designed to address the issue of France and Italy using extensively cyclical devaluation to offset more structural issues. That's the first thing. The second thing is you're right, exchange rates matter. And the proof of the pudding is how powerful the first episode of QE that the ECB did in terms of exchange rate. And that was what kick-started, again, I think, the recovery in the Eurozone, beyond everything you've done, Thomas, of course. And the last thing I would like to say, we also have a lot of new research that's actually, I think, should make us think harder about the role of the exchange rate, which is what Gita Gopinath is doing at the IMF about, because of most of the trade being actually written in dollar, it's not as much of a buffer as we thought. So I think we have an exchange rate as economists, and everybody here is a very bright one. We should have a view of exchange rate as a tool which should have evolved, and is one part of the monetary toolbox. That's one thing. The second thing is I would like to come back to Germany as well, because I think if you look at the precise situation today, Germany and Italy are undergoing a shock, or their recovery is being delayed, which is quite similar. And if we were talking undisciplined people, hello? Thanks. So, fiscal policy has, as you all know, a cyclical allocation and redistribution function. On the cyclical side, when we look at the north of Europe, whose growth is actually today slowing down dramatically, where monetary policy has been stretched a lot, the question mark is why fiscal policy, which is precisely the national stabilization tool, is not being used more. And that's actually also true for the allocation side, both at the national and European level. We can all do public investment in the energy of tomorrow and in digital, and that's about network, so it's a Euro-wide concern. And I think that has little to do with monetary policy tool. In fact, monetary policy has paved the way for us to do that better. And that brings me to what Thomas was saying about rules versus discretion. And there I agree with you, Vítor, that it's not a binary position. It's not, if I put rules on 0 and I go all the way to a scale of 10 on discretion, then in the European Monetary Union, we are not 0 or 10. Each national country is supposed to have a fiscal space to adjust to specific shock. But if we want a Euro stance, we can have an additional Euro budget to actually get there. And by the way, wouldn't Italy or another country feel less the urge to spend if there was this European little budget that would help with investment, not only for them, but for the rest of Europe? So I don't think it's that binary. I think if I say BICC, nobody remembers what it is, but there is a small embryo of budgetary for the euro area, which we need to make grow.
Now, Thomas, so first of all, time is running, and I promise to give you ample time for questions and comments. And I would like to close our initial discussion relatively shortly. But also, before closing that, I also would like to all of you to say what's your recommendation for the years to come. So what needs to be done to make the euro, either single currency monetary union, function better? So Thomas, let's start with you, and then I would ask the other three panelists too, and then I will open the floor for all kinds of questions and comments.
It's a pity we're running out of time. I would have had about an hour's response to Ashoka.
Certainly, you can also use a few minutes to respond to some.
I just think we need to take care that we don't look at very recent episodes of economic history and economic policy history and do some kind of linear interpolation and say the strong get stronger and the weak get weaker. If you look at a less recent episode, after monetary union came into being, Germany was the sick man of Europe. And it recovered by an internal devaluation, which did not come about by Hartz IV or anything like that, but by a concerted pact between trade unions and employers, which resulted in flat real unit labor costs for many, many, many years. And I remember Jean-Claude Trichet coming to each and every Eurogroup and holding up charts of how real unit labor costs in Ireland, etc., were Portugal, Spain, Italy, etc., were developing. And it was quite clear that at that stage, Germany was a weak contributor to the Eurozone economy and was getting out of it. Much to be added on why Italy is in a weak position is that the result of the euro. Every data shows that since the 80s, Italy has been growing a percentage point lower than its European confrère, and that was definitely not the euro. So I think we need to remember that a vast part of policies, as also Vítor and Laurence have been saying, is in the hand of national governments. They can be right, they can be wrong. What we need to do is somehow achieve the political will and the political consensus to bring them together in a better manner than they often have had in the past. Which is maybe part one of my answer. So far, monetary union, MU, takes place, of course, in Frankfurt. There is a very strong knowledge about the inner workings of economic and monetary union in Brussels. But as you go out into capitals, as you talk to national politicians, to national parliamentarians, there is a total lack of comprehension of what needs to be done in terms of policy coordination to make the euro area work better. there is a total lack of comprehension in many member states on the part of trade unions, employers' organizations, and so forth. So there is a huge deficit in political communication, and it is necessary but not sufficient that finance ministers meet every 4 weeks and do either the right or the wrong thing. Second, I would talk of banking union, capital market union in the sense of having cross-border banking, especially cross-border banking, take place as if it were in a national market. For that, we need to overcome considerable hurdles to cross-border consolidation, and we have to work peu à peu towards completing banking union. And that is something which is a much more realistic target than talking about a fiscal union in the sense that there will be a sharing of sovereignty or anything like that in the course of our lifetime. That'll take a long time. So on fiscal, I think the real important thing is to make the rules more intelligible, more simple, and come to a kind of agreement on who exercises discretion on applying them. How do we want totally inflexible rules, as we have had in the past, and somehow, when things don't fit, devise new rules to fit reality? Or do we want to say, we want a much simpler set of rules and give, for example, to the Commission a higher degree of flexibility and discretion in applying them? So that's the kind of discussion that needs to be had. But the complexity of the whole exercise needs to be reduced. So lots of other things, but I'm sure that others will contribute them.
Thank you. Now, Ashoka, so what needs to be done to somehow shore up the euro?
So just picking up on the last theme of fiscal rules. So there are many people who have talked about this, but the person who got this completely right was Romano Prodi. It was what, 2003. And he said the rules are stupid. And what Prodi meant by that, the phrase is often quoted, it was stupid. What he meant by that was that they are rigid and that there should be flexibility. But what Prodi also meant was that he should have the flexibility to decide how to implement them. And that is the fundamental question, always. Who will exercise that discretion and flexibility? The fact that the rules exist is an admission that there is no political authority that is going to be able to claim the legitimacy to exercise that discretion. The phrase intelligent rule implies intelligent flexibility, which implies a political legitimacy. So I don't think we should. And then, then there are the things like sanctions, that if you don't do X, Y, Z, we will sanction you. There's never sanction. There's no sanction. There never has been a sanction. There never will be a sanction. And what's her name? Chancellor Merkel got this one right. When Schäuble was talking about, sanctioning for deviation from the rules, she said, that's idiotic. You're going to put a country that's already in crisis with a penalty on top of it. So my suggestion on this is get rid of the rules. The rules do not serve an economic function. I disagree very vehemently with the proposition that a bad rule is better than no rule. A bad rule is worse than no rule because it either creates countercyclicality or it creates discretion and arbitrariness. And the person who got this right is, God bless him, Jean-Claude Juncker. They say he has an extra drink every now and then, but at that moment, he has a clarity of mind that is remarkable. So when France was given given latitude in its transgression of the SGP, somebody asked him, why is France getting special treatment? And he replied, because it is France. So the rules create political animosity, and they do not serve an economic purpose. Get rid of the rules. I believe that Chancellor Merkel had this right also, that ultimately the only way to create fiscal discipline is to go back to a mechanism where there is debt restructuring and discipline from the financial markets. I know that this is anathema to a lot of people in Europe, but that is fundamentally how the American monetary union existed before a fiscal union, and there is no alternative to that. I had one other sort of technical suggestion at one point. I'm less sure of it. I had proposed following up on a suggestion by Franco Modigliani and Bob Solow in the late 90s that the ECB should have a dual mandate. And recently the ECB has itself reopened the question of a different mandate, including whether the inflation target would be symmetrical or not. It's sort of beside the point at this point. The ECB has not been able to raise the inflation rate from 1% for almost 6 years at this point. The idea that inflation rate could go above 2% is interesting, but sort of irrelevant, because by my reading of the data, the inflation expectations have become de-anchored. And there's very little the ECB can do to raise inflation at this point. Therefore, on ECB, my recommendation is sort of less forceful. I think if there was a miracle and inflation reemerged, then a dual mandate would be still a good idea. But on the fiscal policy side, it's clear to me that the fiscal rules do damage, and that ultimately the only way this could work is through some kind of market-based discipline.
Many thanks, Ashoka, for some quite radical suggestions. Now, Vítor and Laurence, I would like to ask you not to comment now, Ashoka, because then we will enter a debate which will last long. In the final round, each of you will have, but instead focus also on your ideas. Yeah. What should be done for the euro area, especially on this macro management issue that you raised in your initial...
Yeah, that's one of the main issues, is that there is no appropriate, adequate policy mix, discussion and decision-making for the whole space of monetary union. And it does not require to solve this full-fledged fiscal union or a European institution in the field of fiscal policy. There are things that have to be introduced to correct what is the consequence of the present rules, because in the first place, nothing is foreseen at the European level, because indeed fiscal policy is the competence of national member states, and there is a fiscal rule for the member states. And the fiscal rule, meaning the Stability Pact, is too much pro-cyclical. So as a result of this absence of anything at the European level, plus the nature of the fiscal rule for member states, the end result is a pro-cyclical fiscal policy permanently at the level of the monetary union. Nothing was more clear than this around 2011, 10-11, when the fiscal consolidation under the rules that were in place led to the double dip of 2012 and 13, which has as the main explanation the simultaneous fiscal consolidation of all member countries at that time. No other advanced economy in the world had a double dip on growth as Europe had. So this has to be corrected. And the first thing that is necessary then is a stabilization function via a stabilization fund at the European level with sufficient resources, with borrowing capacity, organizing transfers, linked with the fluctuations of the unemployment rate, to sum it up, as the IMF has proposed in a working paper about this rainy days fund at the European level. That addresses one of the issues that was well identified from the beginning in the so-called optimal currency areas literature, which was a tool to respond to asymmetric shocks as a necessary tool for monetary integration. That is missing, and it's very important. Second, of course, the Stability Pact has to be revised. Unfortunately, there are now several proposals on the table that go, well, in the right direction. It's not fully what I would propose completely, but I think that both the proposal by the note of the French Conseil d'analyse économique and even the proposal of the European Fiscal Board are good starting points for the revision of the Stability Pact. What they do is that they go for an expenditure rule. They then have certain objectives regarding long-term public debt ratio and get rid then of the structural deficit concept and many of the rules of the present pact. So that's a good starting point. Both proposals, in my view, need changes, but they are there and they should be considered. And then national fiscal rules as part of monetary union would not be as procyclical as they are now. These two things are important. Of course, the European semester could be used to really discuss some attempts of coordinating fiscal stance of the different member states, but it's hopeless because indeed it's national sovereignty, and in the treaty these are competences of the member states themselves. So it's the other two things that are essential in this respect. The second thing that is needed is an European safe asset. An European safe asset without mutualization is very important for several objectives. The first one, which should appeal to the Central European countries, is that an European safe asset without mutualization is the only solution to the problem of the concentration of banks' portfolios on domestic sovereign debt. There is no other smooth solution to that problem without an European safe asset to diversify in a mandatory way the portfolio of banks. And the third thing that would be in my list of priorities would be indeed the decision and implementation of EDIs as a very important symbol of what means banking union and the interdependencies that are behind the justification of banking union. So stabilization fund, European safe asset, EDIs would be my three priorities, embedded, of course, in a broader description and justification of the type of reforms that I am envisaging, but that I have no time to develop.
Laurence, can you say in 1 minute which of the three you agree?
I will stick to 1 minute. First, on monetary policy, I actually don't disagree that a review is necessary. Last time was 2003. Since then, a lot of things have changed. The mandate is not up to the ECB, but the monetary policy framework is. On the fiscal side, I think what you propose is only possible if there is already a fiscal common budget, because we can only let country default, like in the US, if there is a buffer of federal spending. So it's going round in circle, and I'm in favor of adding a euro budget for the sake of designing a euro stance and investing in the future. And one thing I would add is there's a whole new stream of economics looking at perception, trust, confidence, which is something we've mentioned a lot here. And I think the EU has a sort of unique opportunity in the short term to leverage on this. Whether or not the Brexit is soft or hard, there will be sectors affected in Europe. It will be agriculture, it will be electronic equipment, it will likely be chemicals, because the value chain of this sector is integrated throughout European countries. So at the aggregate, the impact may be small, but for some sectors, it will be a huge shock, either because they export to the UK or because they build up machines together. For example, a German car has more than 15% of input coming from other European countries. So if there is a shock which is common to all Euro area countries, do we have the European capacity to address it? And the answer is yes. And Bruegel actually has mentioned it in different circumstances in the past. And there are two tools. One is the European Fund for Adjustment to Globalization, which admittedly is very small and very complicated to use. And the other one is the European Social Fund, which is much, much bigger and much simpler to use. And if the EU is able to react to a Brexit shock by protecting the sectors and the workers on the European continent from this shock with EU money, then I think in terms of confidence restored into the EU, we'll have made a gigantic step.
Thanks very much also for some very concrete suggestions for the near term. Now, let me open the floor for questions and comments. So if you would like to ask a question or raise a comment, please raise your hand. I would like to briefly introduce yourself and also try to keep your comment or question very short so that we can give more people the chance to talk. Maybe we'd start with Eric over there.
Right, I'm Eric Nielsen at UniCredit. Ashoka, I'm very flattered, working for a bank, I'm very flattered by your suggestion that you don't need rules because the financial market will do the disciplining, but it's an illusion, right? Inside a currency union, we saw it in Italy, we've seen other places, the way the market reacts to things they don't like is to sell very aggressively the bonds of the sovereign, and thereby imposing de facto a tightening on policies. When Britain did something stupid, like Brexit, you sell the currency, you don't sell the gilt. And that gets, in your book, should give some stimulus to Britain. It didn't actually, because as you talked about, in countries that's well developed, we know well that the currency doesn't really work that well. All the weaker pound did was to push up inflation and take real income down for the Brits. Exports have not expanded more than global trade since. Turkey did actually. So when the Turks did something bad and you had the lira depreciation, you have now a faster recovery than people expected. So my point is, you cannot get away with the need for rules or institutions. You pick one of the two. The financial markets cannot be relied upon, flattering as it is, cannot be relied upon to do the job for policymakers because we are way too aggressive and it overshoots when we see things. And inside a currency union, as I said, you hit the sovereign debt and thereby becoming pro-cyclical instead of being cushioning if you did it in the exchange market.
Thank you. Then there's a question on the back. Can we get the next mic here? Can you bring the next mic here?
Thank you. I'm Ioannis Tikidis from Cyprus. I have a few brief comments. One is about bank resolutions, one about exchange rates, and about trading and problems with the Eurozone. Now, about the bank resolutions, we have a case of a bail-in the Eurozone. It's in Cyprus, but a case in which we resolved two banks, one bank in 2013. I'm making this as a point of fact, not raising any big issues. So a case in which the second biggest bank of the country was resolved by bail-in, was forced to merge with the biggest bank of the country, and in 2018 we had the second resolution of the bank, the third biggest by 2013 numbers. That was done orderly, without a bail-in, but with a bailout, for the record. Now, the other point is the exchange rates. The exchange rates matters, but not for every country in the same way. If you're an importer in a big way, and your exports are mostly services, then you can adjust your prices if you're a price taker and do away with the impacts of not valuation. But for the big economies, that's a different story, right? If you're an industrial exporter, the exchange rate is important. Now, if you don't have the exchange tool in your hands, then the issue becomes one of how to adjust, and adjusting by the wage route, the tenant valuation, is always politically slippery, and it has some limits as to how much and to what extent and for how long you can do it. So here we need more innovations in terms of tools, how to adjust internally. We can turn it to trading policies because fundamentally the problem in the Eurozone is one of trade. We have 18, 19 countries with different productivities, right? And they are lacking in their exports successes, and that creates problems which show up in trade imbalances, in debt build-ups, and debt crisis, eventually. Now, looking into the solutions we've had for the past 10 years, with the ECB has been instrumental. But don't forget the fact that when you acquire 1/3 of your country's debt, then your bond market is dead. So the tools in the hands of the ECB today are not there.
Okay, thank you. George Sapari.
Thank you. George Sapari, Hungary. Ashoka, you had 2 points against the euro. One was that different levels of development. Now think of Italy having lira. The difference between northern Italy and Mezzogiorno in the south will not disappear. So that differences exist even within countries, even within Germany. Your second point was exchange rate is a shock absorber. It's a shock absorber, but if you look at what happened in Europe so far, the shocks were domestic made. Even when you had the subprime problem coming from outside, it affected the people who did not, or the countries who did not have strong fiscal policy or had too many toxic assets. So basically, it was a domestic shock. So now, what I say is that you can follow good and bad policies within and without the European Union. If you follow bad policies, it's better if you are out. It's better for the monetary union because you don't have the Greek type of problems. And it's better for the country also because indeed it has more instruments to deal with it, including the exchange rate. But following bad policies cannot be a goal. So you want to follow good policies. And if you follow good policies, then the question is, does the euro help you to follow good policies? And I say yes. Look at Portugal. But look at the Baltic countries. How, they were very much affected by the subprime loan, very, very much, because they had a big credit expansion. When Zsolt and I, we were working on a 10-year project for the European Union, and then I mentioned Latvia, Barry Ehengrin, he said, this is Argentina. Well, where is Argentina and where is now Latvia? And Latvia joined the euro. And they joined in where it was still, the per capita income was still below what it was prior to the subprime crisis. So what I'm saying is, euro, being a member of the euro, actually can help people now forced to follow good policy. Here you are, the Austrian hard currency policy. It's the same thing. Now, the last thought is that what's the alternative? Between 1970 and 1991, there were 19 exchange rate adjustments within Europe. 19. Do we want to go back to that?
Thank you. Francesco, please, briefly, if possible.
Yes, Francesco Badia from Bruegel. I would like to test the audacity of the panel members, possibly including the moderator. I mean, the common theme of the first part was incomplete euro. Now, put a number on that. How much incomplete is it with respect to 100% fully fledged, complete monetary union? I was audacious enough to put the 70% number some time ago. Maybe I would now go for 60. But what's your number if you are brave enough?
Thank you. And there was the very last, I saw a hand over there from a gentleman who may have left. Is someone else? Okay, there's another gentleman. This is the last, or maybe that
Hello, Marta Pirati, European Policy Center. I like very much where all of this is going with the adjustment fund, the stabilization mechanism, as if, and now even a 60% quote. But the bottom line, I think, is how do you get the member states to actually take this money out of their pocket and put it in the common bunch, which we have seen is something that has happened only in the very worst case scenario. So how do you suggest you actually convince the member state to pool money together to make this happen? Thanks.
Can you ask your question in 30 seconds? Okay, then the very last one is from here.
So my question is the same than Miris Magis, which was, by the way, I'm Miguel Otero from Del Cano Institute in Madrid. Miris Magis, which was, can you have a capital markets union without a safe asset? And can you have a safe asset without fiscal mutualization? Because at the end of the day, all the proposals that I've seen, when they are not mutualizing, they don't include the possibility of an exit of a member state. So then it is not safe, because safe assets usually are safe because you have the backing of the taxpayer. So that would be the question.
So thanks very much for all these very diverse and well-made questions and comments. Now I ask the impossible task of the panel to try to respond very, very briefly. So maybe 2 minutes at most for each of you. Ashoka, why don't you start?
So, look, whether markets discipline or not is an interesting question, but it still remains the case that you can never create sensible fiscal rules. Fiscal rules will always be either pro-cyclical or they will be arbitrary. There is no halfway house over there. And to think that there is one is an illusion. There are lots of suggestions, even from my panel here and also from this audience, on variations of a fiscal union. Common deposit insurance, unemployment insurance, safe asset. As the gentleman there quite rightly said, that just think where a safe asset exists. A safe asset exists within the United States. Why? Because it's backed by the sovereign full faith and credit of the US government. Safe asset exists in India, for Indians in rupees. So a safe asset is by definition associated with the nation state. To have a safe asset which has an international character backed by promises which cannot be backed by commitment is not a safe asset. So I say that seeking solutions where we have repeatedly seen that those solutions do not work. The recent example, I was having this discussion in Sweden just a few months ago on the Hanseatic League. When you want a fiscal union and you say, look, we want a fiscal union, it's eminently desirable, we can all agree in this room that the Eurozone needs a fiscal union. So you have to ask yourself the question, when something so eminently desirable has not happened for 50, 60 years, the notion of a fiscal union was discussed in the Werner Committee report in 1970. And every time it comes up, it does not happen. Why does it not happen? Because there are embedded conflicts of interest. And those embedded conflicts of interest do not go away. In fact, they become worse over time. Because as there is a secular slowdown in growth, the sense of scarcity and the sense of antagonism increases. Therefore, the fact that a fiscal union, or call it deposit insurance, or call it unemployment insurance, or call it safe asset, the fact that it does not happen, has not happened in the past, ipso facto means it will not happen in the future. And therefore, the notion that you can somehow finesse the fiscal rules or create something that has the look and feel of a fiscal union will not work. Therefore, when you rule out the impossible, you're left with only something that seems even more impossible, and that's why I suggest maybe market discipline. If you say that doesn't work, then believe me, we are all screwed.
Thank you. Vítor, you can respond to whatever comments you would like to.
Yes, of course. Well, let me go back very briefly to the exchange rate, because there were two questions about it. It's too technical issue. I just want to underline that there is enough recent literature about the decreased efficiency of exchange rate fluctuations in terms of price pass-through, in terms of relative prices, and so on. And indeed, if we look to the experience during the monetary union, we see, for instance, that the export shares, both in total exports of the EU and in world exports, the export shares of Portugal, Spain, Ireland have been stable throughout this period, in spite of the fluctuations in competitiveness of these countries that lost real exchange rate at the beginning and then corrected afterwards. In spite of that, stability. And you find also published by the ECB several working papers showing this diminishing role of exchange rates. So it's a debate to continue, I'm sure. Even the very recent publication of the external sector report by the IMF has a feature about some reduction of the efficiency of the exchange rate in the world economy. Yes, some reduction, yes. Even the IMF has that. So, and there is, as I say, many other academic papers. So, on how much complete, I would take your number, 70%, yes, I would take your number. I hadn't thought about that at all, so, but it's within the range I would put it. Regarding the stability fund, the stabilization fund, why countries would be willing to participate? Well, it's the result of two things. First, the proposal of the IMF about the stabilization fund that they propose, they show by simulations and backward analysis that all countries at a certain point in time would benefit from such a fund. So it was not a permanent direction to the same countries all along. And then, of course, that had to be kept if that would be the case. No permanent transfers would be allowed under an appropriate concept of such a stabilization fund. So the IMF provides this evidence. And then we have to consider the other thing, which is the important point about the whole idea of a monetary union. It's a collective endeavor. It links the countries in the fundamental way. And it's very difficult, as we all know, now to go back in time and unscramble the whole monetary union. That would be indeed a nightmare. So it's the interest of all countries to have a smoother functioning and more efficient functioning of monetary union. And this is a very fundamental thing, because the initial concept was too minimal, too narrow. It was, I have used a caricature to characterize what was the initial concept, which was as if we had organized in Europe a very big currency board where many peripheral countries were adhering to an ersatz of the Deutschmark. It's not that a monetary union. And as we realized with the crisis, and then a response had to be organized in a hurry. So it's a collective endeavor, and that's why the Stabilization Fund would be very important. Finally, on safe assets and the market discipline. Yeah, there are no safe assets 100% anywhere. All countries can be downgraded in terms of credit risk. Even the US was downgraded by S&P, and so on. So it's a matter of degrees, of course. And we can have really a much, much safer European asset without mutualization. And my preferred proposal is the one that is organized about degrees of subordination of the remaining of national debt after a layer of European securities is issued by a European entity. So that is possible. And market discipline, to finalize, meaning debt restructuring in the end, that already exists, because in the treaty, intergovernmental treaty about the ESM, it is clearly stated that no assistance, no loans can be given to any country if a debt sustainability analysis proves that the debt of that country is not sustainable. So it is already in the rules that ultimately debt restructuring is something that is foreseen, contemplated in the present rules. And that has been reinforced by the decision last December that this debt sustainability analysis will be done not just by the Commission, as it was before, but now as a joint venture between the Commission and the ESM itself, which is a body which has not institutionally any degree of independence comparable with the Commission, so much more dependent on the creditor states. So that indeed already is in the rules, that possibility that in the end, if indeed a country deviates too much with fiscal laxity, it can have to contemplate, even before any assistance, a debt restructuring.
Many thanks. Laurence, very quickly, some final thoughts, including your number to Francesco's question.
The question Francesco asked is political, and I'm an economist, so I will skip it. I will just focus on the dollar versus the euro and the safe assets. So the exorbitant role of the dollar, where does it come from? It's used by 300 and more consumers. The amount of dollar assets on financial markets, trade, and the strength of banks, if I oversimplify. Where's the difference with Europe? The amount of consumers roughly the same. Trade, it should be proportionate, and we shouldn't have to use the dollar so much, especially when we are 300 and plus million consumers. So I think it has to do a lot with banks and what has been said on banking union and with the safe asset issue. Banking union, I think we've talked enough about it. Safe asset, frankly, I think we can't escape mutualization, whether it's because we issue a euro bond or because we construct mutualization. But why would the financial market believe in a safe asset that is not supported by the states of the euro? Escaped me. So I think we need some mutualization.
Thank you. Thomas, last but not least, please.
Well, you know, one of the difficulties in discussing these issues is that many people have this ideal picture of perfectly working markets in their head. And if you can't organize yourself like the large internal market of the United States, you ain't working and you're doomed to failure. And I think that's utterly untrue. In the case of fiscal, I agree with what Eric was saying, but it's quite simple. You need a set of rules, and the rules have worked to the extent that fiscal behavior, fiscal policies were better than they would have been had there not been the rules. The question is, can we produce rules that make a better outcome? Can we produce rules that will produce the fiscal policies of the United States? For God's sake, no. But that's something that, especially at present, is deeply undesirable. We need something that produces better outcomes and not optimal outcomes. Same thing goes for capital market union. Does capital market union function without a fully mutualized safe asset? It can be much better than functioning than it is at present. There are quite a number of suggestions on how to produce a safe asset, and some of them work pretty well even without full mutualization. So voila. Just to reinforce my final point, those that say that life is terrible and we're all doomed to failure because within a few years we cannot produce the perfect drawing board solution of a perfectly working economy, that's not how the world works. We simply need to work on getting better and better and converging towards a higher level of intelligent integration that respects the constitutional constraints that we have and that moves us forward. I think it's quite simple. So the perfect, to put it differently, the perfect is the enemy of the better.
Okay. I have to say I very much enjoyed this discussion, not least because there's a major disagreement, not just on the diagnosis, but also on what to do. Abolish rules, keep the rules, rule didn't work, rules had some impact, need cyclical stabilization, safe asset works without mutualization, doesn't work. So I think there were many different views. So I cannot summarize key conclusions from this session, but it was not the goal. The goal was to discuss, and I think we managed to discuss quite well, at least I very much enjoyed. So my last task is to ask to all of you to help to thank all the panelists for their very excellent contributions. Thank you very much.